when that debt loses value, the purchasing power of those dollars goes away. And now we can call it colloquially gold revaluation because when it does happen, and it will happen either by market forces or by diktat, when it does happen, nothing happens to the physical assets in the world. What happens is that the purchasing power gets sucked out of all the debt, which will no longer be paid at the same gold rate, and it gets shoved into gold itself. And so it looks like a gold revaluation, whereas it's not the gold that's being revalued, it's the debt that's being revalued. And as a result, all of the debt holders, meaning all of the dollar holders, have much less purchasing power, and all of the purchasing power that they lose goes into the gold holders, the money holders, the money owners.
The concept of gold revaluation has resurfaced as speculation grows over potential moves by the U.S. government to adjust the value of its gold reserves. While some see this as a financial boost for the Treasury, others warn of broader economic risks. Rafi Farber of Endgame Investor argues that gold revaluation is not about changing gold's value but about adjusting the financial system. As debt loses credibility, its purchasing power shifts to tangible assets like gold, creating the illusion of revaluation. This shift signals a collapse in the debt system rather than an increase in gold's intrinsic worth. Talks of gold revaluation intensified after newly appointed Treasury Secretary Scott Bessent hinted at the possibility of monetizing the asset side of the U.S. balance sheet. However, Bloomberg later reported that President Donald Trump's top economic advisors were not seriously considering the idea. Some analysts argue that revaluing gold to bolster the government's balance sheet may not be the most effective strategy. While it could provide immediate liquidity, it may also undermine confidence in the U.S. financial system by signaling deeper structural issues. Farber argues that gold's rising value stems from the declining purchasing power of currency rather than its intrinsic worth. As debt-backed assets lose value, gold holders can maintain or grow their wealth, unlike dollar holders facing erosion. President Trump's recent remarks on U.S. Treasury debt introduce uncertainty, potentially shaking confidence in Treasury bonds as safe assets. A decrease in trust in U.S. debt may lead to a quicker shift towards gold as a refuge. While revaluing gold might appear to provide a fast solution for U.S. finances, it raises concerns about the monetary system's stability. Historical patterns indicate such measures could signal deeper financial issues, underscoring gold's important role in the changing economic landscape. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Today we're going to talk about that big thing in the news of the monetary people that all the gold and silver bugs are talking about, and that is gold revaluation. The truth is, there's no such thing as gold revaluation. Gold is a metal. It's a thing that's in the crust of the earth, and you dig it out, and the market values it at whatever it values it. You can't revalue gold by fiat, by dictate, by diktat, by order, but what you can do is revalue the dollar, because the dollar is an invention. And really, it's not even dollar revaluation, because if the dollar is an honest derivative of gold, meaning it is backed 1-to-1 by a certain amount of gold that is not messed around with, then there is no revaluation, because if it's a 1-to-1 derivative, then dollar revaluation would be gold revaluation. You can't revalue gold. The market values it at whatever it values it, in terms of other goods and services, of course. And so what are we really talking about when we say gold revaluation? Well, the Federal Reserve's balance sheet consists of certain assets. One of those assets is gold, valued at $42.22 an ounce. That gold really belongs to the Treasury, but it is on the Federal Reserve's balance sheet. The rest of the balance sheet is all paper. It's all different forms of debt. Most of it is Treasury debt. Some of it is mortgage-backed security debt. Some of it is other debt to the Fed. And what we call colloquially the dollar is the cumulative sum of everything on the Fed's balance sheet. And now, since gold cannot be revalued and the dollar is really the sum of every asset on the Fed's balance sheet, as the Fed issues the dollar, therefore the definition of the dollar that we call the dollar is everything that is on the Fed's balance sheet. And so when we talk about gold revaluation, we're not really even talking about dollar revaluation. We are talking about debt revaluation, because that is what can actually be revalued. When you say you are not going to pay your debt anymore, your debt becomes worthless. And so, what really is a gold revaluation? It's a debt revaluation, it's a debt default. And when the debt is no longer paid because it is only paid on a certain pro rata rate relative to gold, which is the actual money, then the debt loses value. And since almost all dollars today are representative of all of that debt, when that debt loses value, the purchasing power of those dollars goes away. And now we can call it colloquially gold revaluation because when it does happen, and it will happen either by market forces or by diktat, when it does happen, nothing happens to the physical assets in the world. What happens is that the purchasing power gets sucked out of all the debt, which will no longer be paid at the same gold rate, and it gets shoved into gold itself. And so it looks like a gold revaluation, whereas it's not the gold that's being revalued, it's the debt that's being revalued. And as a result, all of the debt holders, meaning all of the dollar holders, have much less purchasing power, and all of the purchasing power that they lose goes into the gold holders, the money holders, the money owners.
Speculation has been growing around the idea that the U.S. Treasury could repeg its gold holdings at a higher value, which would generate immediate liquidity for a government looking to improve its financial position. Some analysts argue that the U.S. should revalue its gold reserves from the long-standing $42 per ounce set in 1973 to current market prices exceeding $2,900 per ounce. Doing so could give the Treasury a sudden balance sheet boost of approximately $750 billion, potentially reducing the need to issue new bonds to fund government spending. Such a decision, however, would likely require congressional approval, as it involves a fundamental shift in the financial structure of the U.S. government's gold holdings. Unlike most countries where central banks manage gold reserves, U.S. gold is held directly by the Treasury rather than the Federal Reserve. In turn, the Fed has gold certificates corresponding to the value of the Treasury's holdings and credits the government with dollars in exchange. Rafi Farber points out an important distinction. The Treasury legally owns gold on the Fed's balance sheet. In a financial crisis, the Treasury could claim control over the gold to stabilize the economy, potentially sidelining the Fed. Revaluing gold might offer a short-term fiscal boost but raises long-term concerns. While it could alleviate immediate financial pressures, such a move might reveal more profound issues in the U.S. monetary system. It could weaken confidence in Treasury bonds, which are vital for global economic stability. Let's get back to the interview.
This chart I got from Daniel Oliver of Mermacan Capital, his latest piece, which is called Gold Revaluation, which is an Orwellian term for debt revaluation. But anyway, he has this chart, and I say here that gold revaluation, in quotes, doesn't revalue gold. It revalues the dollar, which is mostly treasury debt. Here we have gold as a percentage of Federal Reserve assets. When people talk about the price of gold and has to back all dollars, what they really mean, even though they don't mean it, is that it has to back all base dollars. The Fed is responsible for printing base dollars, and then those dollars go into the banking system, and the banks can pyramid more debt on top of that dollar debt that is owned by the Fed. But when we're talking about a 100% backing of the dollar, we're not talking about the M2 money supply. We are talking about the Federal Reserve's balance sheet. So up here is 100%. Let me move my beautiful face out of the way. 100%. We reached 100%. We actually reached 130% in 1980. We did reach the 100% mark, meaning the market price of gold in dollar terms was able to back the Federal Reserve's assets by 100%. It was actually above 100% when we reached 872 on the morning of January 21st, 1980. We hit 130% backing. And from there, we've headed down ever since. You can see where we are now. We're about, what is it, like maybe 5, 6, 7% gold backing at the current market price. So there's a long way to go for the gold price here in dollar terms. This is the statutory rate at $42.22. It's now at 0.1%. So there is plenty of room to go on gold, and it's not too late to buy. That you can see here. Auditing the Fed, there's rumors of Ron Paul maybe auditing the Fed. Elon Musk is supporting it, but you should know that auditing the Fed will be the prelude to ending the Fed. And ending the Fed means ending their unit of liability, which is colloquially known as the US dollar. ending that unit of liability will leave the purchasing power, everyone who has those things, down to zero, and they will be left with whatever physical assets they have left. So it will not be painless ending the Fed. It will be very painful for a lot of people who own a lot of the Fed's liabilities, meaning if your bank that holds your deposits goes bust, then you have no more deposits. And if there is nothing to bail them out with, you will lose your deposits. So the end of the central bank means everybody loses their dollars. So what does he say here? This is very exciting. It's also very scary. Just because the Treasury will instinctively defend the Fed does not mean it will not eventually surrender to the market, however. Indeed, says Daniel Oliver, if defending the Fed allows Congress to continue its profligate spending, then, like the gold pool in the 1970s, the Treasury's efforts will unleash the financial forces that will overwhelm it. This is when the legal distinction between the Fed and the Treasury and owning gold versus owning a claim on gold will manifest. What he's talking about here is the Fed does not own the gold that's on its balance sheet. The Treasury does. And this puts a fork, a wedge between the Fed and the Treasury because the gold is on the Fed's balance sheet, but the Treasury owns it. And when both institutions are in a lot of trouble and they both need the gold, the Treasury has dibs on it because they actually own the gold, whereas the Fed only writes claims to the gold on its balance sheet. That's what he's talking about here. And what he's essentially saying is when
Adjusting the official value of gold might offer a temporary financial advantage, but it also exposes underlying weaknesses in the global monetary framework. If confidence in debt-backed assets continues to decline, will nations increasingly turn to gold as a foundation for economic stability, reshaping the financial landscape for years to come? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.